David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Seth Edgil are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Welcome everyone. Today we're diving into a topic that's on a lot of people's minds: how to invest even when you're on a tight budget. Joining us is Seth Edgil, a financial advisor with Keystone Financial Group, to offer some insight into how we can get started. Seth, thanks so much for being here with us today.
Thanks for having me. This is such an important conversation, and I'm glad we're tackling it today. Investing might seem intimidating, especially if you're managing a tight budget, but there are definitely ways to make it work for you. It's not just about having large amounts of money. It's about discipline and using the resources available to you to build a foundation.
Well, let's jump right in. When people think about investing, they often picture needing thousands of dollars. But what about those with a limited budget? Is it possible for them to start investing?
Absolutely. You don't need to have a large sum to begin investing. The key is starting small and being consistent. Even with a limited budget, making small contributions regularly can help you build wealth over time. I think the biggest misconception is that investing is only for the wealthy. But in reality, anyone can take advantage of the power of compounding. What I often tell clients is that the hardest part is just getting started. Once you make that first investment, you realize it's not as complicated as it seems. With all the low-cost options today, like fractional shares and apps that let you invest small amounts, it's easier than ever to begin with what you have.
Well, that sounds promising. Well, let's talk about those tools. You mentioned tax-advantaged accounts. What are they, and how can they help someone who's just starting out?
Tax-advantaged accounts are a great way to invest because they offer either tax deferral or tax-free growth, which can maximize your savings. For someone with a tight budget, every little bit counts, and reducing the tax burden on your investments makes a big difference in the long run. Two of the most common types are Roth IRAs. These are particularly beneficial for younger or lower income earners. Contributions are made with after-tax dollars, so you pay taxes up front, but your investments grow tax-free, and withdrawals in retirement are also tax-free. It's an excellent option for those who expect to be in a higher tax bracket later in life. Traditional IRAs and 401ks. With these accounts, your contributions are typically tax deductible, which can help lower your taxable income. This can be useful if you're looking for a tax break now, and you'll pay taxes when you take money out in retirement, likely at a lower rate. Using these accounts, you're also benefiting from compounding interest over time. Even if you're only able to contribute a small amount each month, you're still getting that tax advantage and giving your investments a chance to grow, which can really add up over the years.
Well, that sounds like an efficient way to build wealth, especially with tax advantages. But let's say someone is really living paycheck to paycheck. How do they find the room to invest at all?
That's a challenge many people face. But it's about finding those little pockets of extra cash, even if it seems small. The key is to treat investing like a non-negotiable expense, almost like paying a bill. Start small, even if it's just $25 or $50 per month. Over time, consistency is what drives growth. What I suggest is tracking your spending to find areas where you might be able to cut back. It could be something as simple as reducing dining out or other non-essential expenses. Even those small changes can create room in your budget for investing. Also, consider automating your investments. That way it becomes a habit and you don't have to actively think about it every month.
Well, that's great advice. And for someone with limited funds, what types of investments should they consider? Should they be more conservative with their choices?
It really depends on their individual financial goals and timeline. Typically, the younger or longer you have until retirement, the more risk you can afford to take on. This often means focusing on stocks or stock-based funds, which historically offer higher returns over time, but can be volatile in the short term. For those who are more risk averse, Or if you're nearing retirement, you might lean toward a more conservative approach, such as bonds or bond funds, which are generally more stable but typically offer more conservative returns. Of course, each investor is different, and each investor will have their own unique risk tolerance. Said in a different way, every individual has a different level of risk they are comfortable with taking. Also, it must be said that past performance of certain asset classes is not necessarily indicative of future returns.
Well, that sounds like a smart way to simplify things. But what about those who might feel overwhelmed by the idea of investing, even with these tools? How can they make sure they're on the right track?
This is where working with a financial planner can make all the difference. A financial planner doesn't just help you pick the investments. They help you build a strategy based on your unique situation. They'll look at your income, budget, debt, risk tolerance, and long-term goals to create a personalized plan. For people who are overwhelmed or not sure where to start, a financial planner can offer that much-needed guidance. They help you avoid common pitfalls like taking on too much risk or not having enough diversification in your portfolio. The peace of mind knowing that someone is helping you make informed decisions is invaluable, especially when you're working with a tight budget. With my clients, this involves the use of state-of-the-art financial planning software. We help our clients define their goals, risk tolerance, budget, and future needs. Then, based upon assumptions about inflation, rates of return, and risk, we develop a financial plan. In my opinion, a well-thought-out plan will define what to expect when things go well and safety nets for when things in life go astray.
So for someone who's watching, who's interested in investing, but not sure where to begin, what is that first step?
The first step is to start today. Whether it's opening a Roth IRA, contributing to your 401k, or simply setting up a meeting with a financial planner, take action. Even if it's small, that initial step is key. The earlier you start, the more time your investments have to grow due to the power of compounding. Many people believe they should wait until they can contribute larger amounts, but the reality is time in the market often matters more than the size of your contributions. Let me give you a hypothetical example. Imagine you start investing $100 a month at age 25, earning an average annual return of 7%. By the time you're 65, your investment will have grown to approximately $260,000. Now let's say you wait until you're 35 and contribute double, $200 a month, also earning 7%. By age 65, you'd end up with just about $228,000. Even though you invested more per month, starting later cost you about $30,000 in potential growth. The reason for this difference is the power of compound interest. When you invest early, your money has more time to earn interest on both your initial investment and the interest that accumulates over time. That's why starting small today is better than waiting to invest larger amounts later. This example shows how the earlier you begin investing, even if the amount is modest, the greater your potential to grow your wealth over time.
Great advice, Seth. Any final thoughts you'd like to leave our viewers with?
Just remember, investing doesn't have to be complicated. You don't need a lot of money to get started. With the right tools and guidance, you can make your money work for you, even on a tight budget. But it's crucial to seek professional advice to ensure your strategy aligns with your goals. Everyone's financial situation is different, so working with a planner ensures you're taking the right steps for your future, and it gives you the confidence to stay on track even when markets fluctuate or life throws you curveballs.
Well, Seth, thanks so much for your help with this topic today. And for additional information, Seth may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brannon Dawkins.
David Guttery and Seth Edgil independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.